Good afternoon, everyone. Thank you for attending today. Welcome to our Wednesday webinar. Burkett Long is offering a series of fortnightly webinars on a range of different subjects for individuals, families and businesses. By way of introduction, I'm Tej Thakkar and I'm the Head of Regulatory Law here at Burkett Long. This week we are looking at the pitfalls of COVID-related fraud. We will take questions at the end of my presentation, so please do make use of the Q&A facility. So without further delay, let's get started. So COVID-related fraud, there's two sides of the coins when considering this matter. On one side, where a business is the suspect, having made an error or alleged of fraud, including the subsequent failure to rectify any error, and the potential for ramifications of that. And on the other side, the other aspect, where it's been the target of some wrongdoing. Today's webinar will focus on the first of those two, whereby its specific actions, omissions, and ultimately failings result in their coming under scrutiny under the label of a suspect. Next slide, please. So you have on your screen the agenda for today, which looks at the various COVID support schemes, and I'm predominantly going to focus on 4 of those and go into depth on 2 of them. Why the HMRC Taskforce was created and their investigatory powers, which includes the Finance Act 2020, looking at the difference between error versus fraud and what companies should be doing to rectify their mistakes, if any. What happens if the HMRC do come knocking and an investigation ensues? What criminal offences can arise as a result of allegations concerning COVID-related fraud? And the ramifications generally if the HMRC do find any error or wrongdoing. And I've got a couple of examples that I can give you afterwards, and then I'll be open to some questions and answers after that. If we go to the next slide, please. So the unprecedented coronavirus pandemic, aka COVID-19, has plainly had a devastating impact globally and caused significant impact to everyone concerned, from individuals to businesses alike, and consequently it's wreaked havoc on the economy. Indeed, many businesses came to a complete standstill or otherwise hindered, and their ongoing viability, together with that of its employees, were in serious jeopardy. As a direct result, or shall I say response, to COVID-19 and its impacts, the UK government introduced an array of fiscal measures by virtue of schemes, loans, grants and reliefs, which provided vital support through the crisis to many vulnerable companies and self-employed individuals, and mitigated that financial consequence of the pandemic for their business or respective trade. I'm going to touch on some of the most common and widely publicised or discussed schemes, which are prominently identified as the arena or terrain for both honest errors to have occurred, but also otherwise been subject to fraudulent activity and claims. The coronavirus outbreak and associated containment measures have caused huge economic fallout across the world, and before looking at those individual schemes, it's important to understand the context upon which those schemes have directly impacted the government and why it's so important that the misappropriated funds are clawed back. In simple terms, the impact is twofold. Firstly, the sharp decline in economic activity that was occurring will have depressed government revenues and pushed up public spending. And in addition to that, the government have, appropriately I should say, responded with packages of fiscal measures that will help support households, businesses and public services through those challenging times and limit the long-run damage done by the crisis. So the government introduced a substantial package of fiscal measures, both immediate, interim and deferred, in response to COVID, putting the amount of support into hundreds of billions of pounds. So the first two, which are the top 2 on your screen, the Coronavirus Job Retention Scheme and the Self-Employment Income Support Scheme, and I'll deal with them shortly, but I want to start first with the 2 loan facilities. The first is the Bounce Back Loan, and that was designed to enable small and medium-sized businesses to access finance more quickly during the coronavirus outbreak. It enabled businesses to borrow between £2,000 and the lower of 25% of their turnover, or £50,000. As with any loan, they have to be repaid back, but there are no fees or interest for the first 12 months, and the fixed rate thereafter is applied. Notably, the government guarantees 100% of the loan. In short, the applicant business has to be based in the UK, established before the 1st of March 2020, and adversely impacted by COVID. The second of the loans is the Business Interruption Loan, and that's to offer financial support via loans and other finance schemes up to £5 million, and the scheme was only available for those businesses based in the UK with an annual turnover of up to £45 million, who could also show they would be viable, save for the pandemic, and they have also been adversely affected by COVID. It's important to note with the latter, lenders would require documents evidencing their ability to repay, such as management accounts, cash flow forecasts, historic accounts, and asset lists. The two loan schemes have been successful in terms of uptake. By the end of 2020, approximately £62 billion of loans were made under the respective schemes. However, alongside that success, there have been significant reports of fraud and other criminal activity associated with schemes. The National Audit Office reported that it estimated 60% of the loans will actually never be repaid. And it's easy to see the types of abuse that appear in those sort of loans. Artificially inflated or deflated turnover, how the impact of COVID adversely affected those businesses, and then falsifying accounting records to obtain the loan that they wouldn't have otherwise qualified for. However, the two most used and most expensive schemes to the government is the Coronavirus Job Retention Scheme, otherwise commonly referred to as Furlough, and the Self-Employed Income Support Scheme. And these are the most targeted areas of the HMRC, thus are going to be the primary focus of today. The reasons they are the focus is because of the self-declaration aspect. There was a low level of scrutiny or checks, unlike that of the banks, which offers a terrain for both errors, but also disguised fraudulent activity to take place. However, it's important to note that the issues and respective approaches equally apply to the majority, if not all, of the corresponding schemes, grants and loans that are born from the suite of government measures aimed at keeping businesses afloat and jobs intact. Next slide, please. So looking at the CJRS or furlough scheme, in March 2020, the government felt it was necessary to lock down the country, thus to prevent the spread of the virus, which forced businesses to either close swiftly or adapt to remote working. For many businesses, lockdown has been mildly inconvenient at best and cataclysmic at worst. Certain industries such as the hospitality and travel have been particularly affected, and millions of workers were put at risk of redundancy as a result. It's in that context that on the 20th of March 2020, the Chancellor announced the Coronavirus Job Retention Scheme, commonly referred to as Furlough. And the word furlough, as we may or may not know, means a temporary leave of absence from work. And it's a term that was relatively unknown until a little over a year or 2 years ago. However, much like COVID-19, lockdown, social distancing and bubbles, it slipped into everyday language since the pandemic began. It was introduced at fairly short notice with the purpose to support employers who could not maintain their workforce because their operations had been adversely impacted. It allowed all UK employers with employees on PAYE schemes to retain employees even though they were not working by placing them on furlough. Thereafter, the business, were allowed to claim for a period from the 1st of March 2020 financial support in the form of a grant up to 80% of a furloughed employee's salary, to a maximum of £2,500 per month, along with national insurance and pension contributions. A furloughed worker then, or perhaps I should say should then, receive 80% of their wages funded by the government, with the employer having the option to pay the 20% top-up difference. Now, under the furlough scheme, employers have more recently had the choice to either fully furlough employees, that was what was there at the outset, which means they cannot undertake any work for their employer, and as mentioned, the employer can claim up to 80% of their employees' wages, up to the maximum. The second is the flexible furlough scheme, which was available from the 1st of July 2020 onwards. It means that employees can do any amount of work and any work pattern, but they cannot undertake work during those hours that they are recorded as being on furlough. Next slide, please. Now, the rules governing the scheme for furlough and the respective options there are complicated and indeed have been extended, and guidance respectively changed since they were initially implemented, the latest currently being extended until the 30th September 2021, albeit with reduced proportions of government contribution. Now, you should see on your screens the table summarising the changes in level of grant from the 1st of July 2021 this year through to September, when the scheme comes to an end. And if you take a look at that top line together with the third line, it shows you the variables and the changes on a month-by-month basis. And so it shows you how errors or mistakes could potentially arise. Next slide, please. So since the inception of the scheme, thousands of employers have furloughed all or part of their workforce and claimed wage costs. And as of July 2021 this year, it's reported that approximately £68 billion has been spent by the government on the specific job retention scheme, with such number continually increasing, having regard to the date of that figure and the subsequent extension until the end of this month. Whilst the furlough scheme and other measures offered a vital lifeline to many businesses, naturally the injection of money becoming available leads to opportunities for inaccuracies to occur from one end of the spectrum of honest, genuine error through to the other end of the scheme of abuse and fraudulent activity. Now, some would say it's fairly straightforward to identify some of the most common inaccuracies or mistakes or miscalculations that can arise in connection with those who have sought to take advantage of the specific scheme, as well as perhaps some of the more complicated scenarios. And I'm just going to run through those. One area likely to result in errors is the reference pay used to calculate the furlough claim. While regular salary forms part of the reference pay, discretionary pay such as tips or commissions do not. Whether pay was deemed discretionary or not could be a matter of interpretation, and leading to employers taking a position that perhaps the HMRC would not concur with. Another area where errors may have arisen comes from the fact that at the start of lockdown, but before furloughing became a possibility, many employers requested employees to use their annual leave. The interaction between paid holiday and days furloughed meant that some errors were identified which required adjustments. Also, at the start of the pandemic, there was an increase in employees on sick leave as they self-isolated when displaying symptoms. The basis of claiming statutory sick pay was changed for those employees who had contracted COVID-19 or were self-isolating, and further complexities revolved around employees receiving sick pay, which may have led to errors. For furloughed employees with variable pay, such as those on zero-hour contracts, the calculation of reference pay was even more complex, as it required a comparison with equivalent pay before furlough, or the average pay since 2019 or later if employment started after that date. Errors in calculating reference pay could also manifest itself where employees participate in salary sacrifice arrangements, as the reference pay was post-salary sacrifice, which may not necessarily have been immediately obvious if simply looking at employees' pay slips. Likewise, the number of hours worked for the purpose of calculating the claim also presented an issue, and whether the employee, whether on fixed or variable pay, worked during the furlough period added further complexity. In the first stage of the furlough scheme, furloughed employees were not able to work, although there were some exceptions, for example, in relation to training and directors performing statutory duties. A potential error could have resulted around misinterpretation of the guidance, so that furloughed employees worked in addition to training, or employers did not properly track which employees had returned to work. From July, part-time working was allowed, known as the flexi furlough, as we saw on the previous screen. And so errors could have arisen from incorrectly identifying hours worked compared to hours furloughed, and therefore hours being claimed. Following the introduction of flexi furlough, changes were also made to the level of wage claim that could be made, as the initial 80% capped at £2,500 a month decreased to 70% in September. Also, the covering of employers' national insurance contribution and pension contribution ceased in August last year, and errors may have arisen in terms of claiming the incorrect rate of employers' national insurance contribution, for example, where an employee was aged under 21, or whether an employer is entitled to claim the employer's allowance, or by mistakenly claiming the employer's pension contributions when in fact they had opted out. In addition to the issue with the pension claims and salary sacrifice, a further issue to consider relates to the actual pension contributions. In April, the pensions regulator issued some updated guidance on the interaction with furlough claims, salary sacrifices and pension contributions. And the guidance carried two clear messages. Firstly, an employee cannot sacrifice furlough pay in exchange for pension contributions. This is because an employee must pay the full CJRS amount to the employee. Salary sacrifices can be operated on any top-up over the CJRS scheme, but may cause issues in relation to the second key message from the regulator for pensions, which was, for pensionable pay purposes, a CJRS payment is treated as a payment after salary sacrifice, and so may need to be grossed up to calculate the pay in order to calculate the minimum contributions required under the automatic enrolment legislation. Other types of errors which may be entirely innocent include examples such as transportation mistakes in data, error in date or computation when inputting the claims online. And ultimately, the rules are complex, particularly for partial furlough, national insurance contributions and salary sacrifices. Next slide, please. So that deals with, we dealt with where errors can occur, but there's also perhaps those instances where fraudulent claims have occurred, or where they were initially made an error and no steps have been taken to rectify that. And so it's that turning a willful blind eye. A fraudulent error may involve employers claiming despite not meeting the scheme's criteria. For example, where a furloughed employee has been asked to do a little bit of work on the side to help the company out, conduct that was strictly forbidden before the rules changed on the 1st of July, or helping out with ancillary work to their mainstream role. Likewise, claims that have been made for individuals who no longer work for the company, or their return to work from maternity leave or sickness absence has been manipulated in a manner that is in breach of the applicable rules, specifically in order to benefit financially from the scheme. Other red flags are where the employers claim furlough payments without passing on all of the money to the employee, or where the employer has claimed for furlough payments, but the employee concerned was not aware that the claim had been made and so continued to work as normal. Potential fraudulent claims arise out of backdated claims or fictitious companies, or perhaps where there's associated companies, furlough entitled work not connected with the employer's business. However, where companies furloughed employees and then have requested them to indirectly service the needs of that company via a third-party company that has been set up. Next slide, please. So likewise, like with the furlough scheme, the self-employment income support scheme was set up by the government to provide support during the coronavirus pandemic for those who are self-employed, either as a sole trader or a partner in a partnership. And I just add that it's an unlimited partnership. You're deemed to have been trading if you've been running a business selling goods or services, and you complete a self-employed or partnership aspect of your self-assessed tax return. Under the scheme, you can still work in your business or do other work such as new employment or volunteering. And the key part is if your business has been adversely affected by the coronavirus, you're able to get money from the government subject to the criteria. And in short, that deals with loss of income or had to stop working to look after someone. Turning to the criteria and how much could be claimed, there are 5 grants in total, and the qualifying criteria for each grant is different. I'm not going to go through every single aspect, but I'll touch upon the key differences between those 5 grants. So for grant 1 and 2, which for the purpose of completeness you can no longer apply for, self-employed individuals and members of partnerships were eligible where they as the taxpayer had submitted a 2018-2019 self-assessed tax return by the 23rd of April 2020, traded in that tax year 2019-20, and intended to continue to trade in the following year 2021. And carried on a trade which had been adversely affected by coronavirus. HMRC provided some guidance of the meaning of what it meant to be adversely affected, and this included being unable to work because the taxpayer was shielding, self-isolating, or was on sick leave, or had care responsibilities because of COVID. It also includes scaling down operations, temporarily stopping trading, or incurring additional costs, whether it be through supply chain being interrupted, the business has had fewer or no customers, staff were unable to work, 1 or more contracts have been cancelled, or at that stage, protective equipment was purchased to comply with social distancing rules. I should add the taxpayer should keep evidence of the impact of their trade, but there was no link between the amount of the grant and the financial loss endured. The list was non-exhaustive. For example, a business might adversely be affected by having to write off bad debt because a customer had ceased trading. The scheme specifically allowed a claim where trade had continued as long as that trade is adversely affected, and during the application process, the taxpayer was asked to confirm that they meet the eligibility criteria. But the importance of that self-declaration process, the questions that were asked, may have been missed by some, and others may have worried about them unnecessarily. The HMRC's guidance was not initially specific about when a business needs to be adversely affected to qualify for the grant. This actually changed, and to qualify for the first grant, the business must have been adversely affected on or before the 13th of July 2020. To qualify for the second grant, it must have been adversely affected after the 13th of July 2020. The taxpayer's trading profits must also not have been more than £50,000 and more than half their total income for either the tax year 2018 and 2019 or the average from the preceding 3 tax years. The amount of the grant is based on the average trading profits for the relevant years. And note that the grant is calculated using the trading profits shown on the tax return, so no adjustment is made for the taxpayer trading for only part of the tax year concerned. And so in short, for grant 1, the scheme was announced on the 26th of March and provided an initial grant for self-employed individuals and businesses impacted before 13th of July 2020, and that was for 80% up to a maximum of £7,500. The second grant was then made available for individuals or businesses and partnerships that were adversely impacted after the 14th of July and that was for 70% of up to a maximum of £7,570. On the 1st of July 2020, the scheme was actually extended to provide payments to certain self-employed individuals or partners within partnerships who did not originally qualify based on the trading profits or total income in 2018 and 2019 because they had parental responsibilities. That leads on to the third grant. Grant 3 was again increased back to 80% up to a maximum of £7,500. But there were additional tighter eligibility criteria introduced as part of that third grant. To be eligible for the third grant, you as a taxpayer would have needed to be eligible for the criteria for grants 1 and 2, but also had to have experienced reduced activity, capacity or demand, or be temporarily unable to trade in the period from 1st of November 2020 to 29th of January 2021, compared with what could reasonably have been expected, but for that adverse effect on the business due to COVID. And on top of that, the claimant reasonably had to believe that the impact would have caused significant reduction in trading profits for the relevant accounting period, compared with what would have otherwise have reasonably been expected as a result of that reduced activity, capacity or demand at point 1. The significant reduction in trading profit tests applied to the accounting period as a whole, and for many taxpayers, for example those who use 31st of March to the 5th of April as their accounting date, the significant reduction of trading profits will have been expected to appear in the results they reported for the 2021 tax return. However, what happens to those taxpayers, for example, that use 30th of April accounting date, who would then not report the trading results for the relevant period until the following subsequent year, 2021 to 2022 tax return? This means that claimants will have had to forecast their results to establish eligibility, and it's an area of potential default and contention that can arise in due course. I mean, HMRC's guidance indicates that it expects, naturally, claimants to make an honest assessment about whether they reasonably believe that their business will have suffered from significant reduction in profits. But that forecasting element is going to be an element of contention. The HMRC has specifically said that reduction in profits due to increased in costs, such as having to buy masks, did not count for this purpose, and that was the difference between grant 1 and 2 and 3. That wasn't a factor that could be sort of taken into consideration at that stage. And no claim could be made, for example, for reduced activity, capacity or demand if it was caused solely by the fact that that person had to self-isolate or care for a person required to self-isolate that had travelled outside of the UK and had returned. Moving on to grants 4 and 5, the eligibility criteria were revised yet again to take into account 2019 and 2020 tax returns, but are otherwise unchanged from the third grant. As before, the trading profits had to be no more than £50,000 or more than half of their total income for either 2019-2020 if they started the business in that year, or the average for the preceding 4 years dating back to 2016 to present date. For the 4th and 5th grants, the HMRC will base its calculations on the tax return data for 2016 to 2017, all the way through to 2019-2020 as held on its system by the 2nd of March 2021. Now, grant 4 was calculated as 80% of the average of 3 months trading profits, that notional figure, up to a maximum of £7,500. However, for grant 5, a turnover test was applied, and I make a key point about it being turnover rather than profit, to ascertain the level of grant that is awarded. For grant 5, it has been set at 80% of 3 months of an average trading profit capped at £7,500 for those whose turnover had reduced by 30% or more. Those with a turnover reduction of less than 30% will receive a grant based on 30% of their 3 months average trading profits, capped at £2,850. So that 5th grant has 2 levels of grant being offered, and it takes into consideration the turnover test as well as the previous profit test. We could turn to the next slide, please. And so the types of error or fraudulent activity, looking at both ends of the spectrum, can arise. It can arise from inaccurate information. And for the self-employed grants, the key risks affecting entitlement are going to be errors in forecasting. The trade was not adversely affected by coronavirus, and for the 3rd and subsequent grants, the impact on trade does not satisfy those additional tests. People still are factoring in those costs in terms of complying with COVID. The trade did not continue for the first 3 grants in the tax year 2019-2020 and for the 4th and 5th grants in 2019 through to 2021. For example, this might have been because the business was incorporated, or simply there was no intention to continue that with that trade. There'll be elements of artificially inflated or deflated trading profits, the meet profits test or the turnover test, and looking at what amounts to being adversely affected. You know, it's a self-declaration process, and business will have needed to consider that, and still do if they're applying for the 5th grant before applying as part of that claims process. Now, your businesses could have been affected for a number of reasons, and this includes if you've not been able to work for periods of time, as I've said, self-isolating, shielding, and consequences of caring responsibilities, or temporarily having to close down. But it may be the case that your business was adversely affected earlier on in the coronavirus outbreak, but then your trading patterns returned as normal. So although you claimed for grants 1, 2, and 3, you might not have been able to be eligible to claim for further grants if you were no longer adversely affected. And you know, in times of uncertainty, you can see how people may have, I'm going to use the term, massaged or portrayed the figures in a perhaps beneficial way due to the uncertainty of the future. There's also instances, as we said, change of circumstances, and those that have been targeted but by organised crime, so subject to scams to make spurious applications. The bottom line is everyone needs to keep their business records to show how the business has been affected and they were eligible to make the claim. And that's certainly going to be important if the HMRC do knock on your door asking for evidence of that to justify your position. Next slide, please. So it's on that backdrop and that context of errors happening, fraudulent activity taking place, and ultimately everyone needing to claw back, the government needing to claw back money, that the Finance Act was introduced, and that was introduced on the 22nd of July 2020. And it gave companies and self-employed people the amnesty until the 20th of October 2020, or 90 days after receipt of payment for the latter claims, to notify the HMRC of potential wrongdoing in respect of furlough claims. Ultimately, they could absolve themselves of specified criminal liability and other related sanctions. The Finance Act also provides the HMRC the ability to claw back amounts wrongly claimed by retrospectively taxing the applicants as an income tax or corporation tax at a rate of 100%, and that even applies where genuine errors have taken place. The legislation also enables the HMRC to impose a penalty, certainly in cases of deliberate and concealed wrongdoing, again up to a rate of 100%. Penalties applied to those who are self-employed, a company or a company officer or officer personally, depending on the circumstances, where the wrong claim might be attributable to the actions that individual can also apply. And the HMRC have publicised their stance insofar as they would seek, initially anyway, any failure to notify and rectify the position outside of that amnesty period, whether it be by 20th of October 2020 or after 90 days of lapse, to be a deliberate attempt to conceal the position. So the perceived landscape is clear that any matters arising post 20 October or following a 90-day grace period will be treated as deliberate and fraudulent and lend concern to investigation or prosecution for criminal offences. Next slide, please. So it's on the backdrop of all of that and with the Finance Act being enacted that we look at how the HMRC Taskforce has come into play. It was announced in the spring budget of 2021. And the key target of the HMRC Taskforce is initially going to be for the furlough scheme and the self-employed income support scheme, which is why we've sort of primarily focused on that today. The schemes were brought in at exceptionally difficult times and was necessarily introduced with a bit of haste and little guidance, but it subsequently became complex, technical, and in the words of HMRC, it was a terrain for those errors to occur, but it was also a magnet for fraudsters. So in September last year, it was estimated that almost £3.5 billion had been fraudulently claimed, and that figure a year later would have doubled, if not increased more. And so as of March this year, the task force was introduced, £100 million was set aside to produce what was known as the Taxpayers Protection Task Force. And ultimately 1,250 HMRC officials have been appointed to investigate and prosecute those who have unlawfully acquired funds. Now, the task force will be actively working alongside other law enforcement authorities and measures to tackle fraudulent activity, including their online whistleblowing portal and a campaign to highlight enforcement methods. But in addition to examining those claims, whether it's through the portal or their investigations, officials would be prompted to sift through PAYE records, tax returns, and other relevant documentation to establish unlawful means of generated income. And the HMRC have publicised guidance on both errors and penalties. So undoubtedly, criminal allegations pursued by way of prosecution before the courts will be reserved for the most serious of cases. This much the HMRC has made clear. And in the vast majority of furlough and self-employed income support scheme overpayments, the HMRC no doubt will prefer to resolve the matter through requiring repayment, and in cases where there's an honest mistake, imposing financial penalties without resorting to criminal proceedings. And the reason for that is very clear: time, expense, and the ability to claw back the money. In criminal allegations, the ability to claw back the money will come at the end of proceedings. But also, one needs to have an eye on the fact that prosecutions will arise for the most serious of cases, but also to act as a deterrent to others. We can go to the next slide, please. So what should you be doing at this stage? Well, while some companies and self-employed individuals may inevitably choose what's known as the ostrich strategy, that is only a worry about the position if they are contacted by HMRC. Such an approach is generally not recommended. Rather, it's better for companies to proactively review their systems and claims to clarify whether they are comfortable that they can justify the claims which have been made, and can, for example, in the case of additional revenue inquiries, legitimately back up their position. By being proactive in this area, companies which have made errors in their claims can ensure that they are in a position to ensure the HMRC is notified proactively, and the risk of penalty to a company is minimised. It may not be removed, but it will be significantly minimised. Moreover, a proactive and clear review process in this area can help ensure that wider relationship of the company with HMRC is as good as possible, and minimise further inquiries, perhaps of a wider scope, considering corporation tax, VAT, and such like. Where the original 90-day window for simply refunding the incorrect claims has passed for the earliest claims, as mentioned above, by reviewing claims for that initial period, if there are any errors, reporting them directly to HMRC even past that period, firms would put themselves in a better position from an overall disclosure perspective. Experience from regular tax audits and disclosures shows that those businesses that are open and forward in their dealings will suffer smaller or even potentially suspended tax penalties. Companies should also proactively review their in-time claims if they wish to avoid unnecessary risks in regards, for example, both criminal and civil penalties, as well as the negative PR associated with HMRC publicising defaulters. As I've said, significant clawback and enforcement powers given to the HMRC under the Finance Act, and that is something that employers and businesses do need to take seriously. Taking the time now to ensure that you have full, accurate and easily accessible records will clearly be important to put you in a good position should the HMRC audit arrive. It's also worthwhile checking the position in case, as a preemptive measure, in case the HMRC investigation does initiate. Although the HMRC primarily focuses, is likely to be on fraudulent claims, the government has said it expects employers to identify mistakes and correct and rectify those claims where genuine error has been made. So ignorance is unlikely to be a defence if the HMRC do come knocking. If you've not already done so, then you are advised to carry out self-audit of your furlough claims and records to ensure the correct amounts have been claimed and the claims are compliant with the rules of the schemes. If errors are detected, further forensic examination may well be required, or if you're in any way concerned, it's recommended you do take advice as soon as possible. And that's going to reduce your risk to potential enforcement action by the HMRC. As mentioned earlier on, notifying and rectifying the position without prompt from the HMRC will reduce the potential liability by almost 70% on a potential penalty. And finally, it's imperative you maintain your business records. This will enable prompt dialogue with the HMRC, and where allegations of wrongdoing are made, it enables the business and you to present a defence package which is substantiated by material in support of your position. Next slide, please. So if the inevitable does arrive and you are investigated, the HMRC have got huge and far-reaching powers. It can range from an initial interview, a request for documentations, inspections and compliance checks, speaking to people within the company and reviewing other records and trading patterns. And it's easy to see how that will arise. If we use the example of furlough scheme for an employee who continued working, the HMRC can simply request business records such as emails, phone messages, customer invoices, and so forth. In the example of claiming for an employee that doesn't exist, they can request employee records, ID records, company records to establish whether that person is even genuine. And in addition to requesting documents, they've granted powers to carry out unannounced searches. In more serious cases, they can exercise their powers under the Police and Criminal Evidence Act 1984 with the assistance of the police, whether it be by way of formal interviews under caution, arrests, or dawn raids. And like we've said, they can claw back those payments by way of tax charges or financial penalty. It's important to remember the HMRC are the investigating government authority, and they will have unfettered and ready access to any claims made by the scheme. This is in addition to important relevant information about businesses and employees, such as tax payments, contributions, and corporation tax. If we go to the next slide, please. So what are the criminal allegations that you could face? I mean, it could give rise to several criminal offences. In theory, any person within a business may be liable for one or more of the offences that are on your screen at the moment. However, those holding the most senior roles within the business are likely to be exposed to the greatest risk. In addition, it's possible for a company as a separate and distinct legal entity to be liable for criminal offences where the relevant conduct is carried out by a person deemed to be the directing mind of that company. And you'll see these are all well-established criminal offences on your screen. There is no specific or direct offence regarding COVID-related fraud, but the Fraud Act 2006 provides for the general offences and the 3 ways of committing it: fraud by false representation, by abuse of position, or by failing to disclose information. False accounting is an offence if you dishonestly falsify any account or record or document made or required for any accounting purposes, with the view of gain for yourself or another, or loss to another. And it's important to note that in all of these fraud allegations, there doesn't actually need to have been a gain. It's the intention to have that gain. And in any event, there's going to be a loss to the revenue, or an intention to claim a loss from the revenue, because they are the ones paying via the scheme. One thing all of these allegations do have in common, and that's the element of dishonesty. Whether it be involving a self-employed person claiming a grant they're not entitled to, or applying under the COVID scheme if you know it's wrong. But ultimately, to be fraudulent opposed to an error, the behaviour would have to be knowing and dishonest. I mean, the scheme was complex and imposed at short notice, and errors and mistakes will understandably have been made on application forms at the time of intense pressure as the coronavirus pandemic took hold. Likewise, there is potential to misinterpret or misunderstand the provisions. If human error has been made by an employer or an individual seeking to apply the provisions properly, then in our view, is not dishonest and is not fraud. And that would need to be clearly explained to the authorities with evidence in support of the same, whether either direct evidence or peripheral. And it's important to note that the test for dishonesty changed in recent years, and there's more of an objective element. So the first part is, what was the applicant's actual state of knowledge at the time? But the second component takes away that subjective element about the applicant and whether he was dishonest, and it's concerned with the dishonesty by the standards of ordinary decent people. So the prosecution must show that any representation was made with the intention to make that gain or loss, and it was done so on a dishonest basis. Naturally, the more sophisticated the planning and the conduct of the fraud, the more serious it will be deemed. But again, businesses need to prioritise this as an area and rectify their mistakes, because the consequences are grave. And the maximum penalty, for example, for fraud offences is 10 years, whereas false accounting is 7 years, but equally all very serious. And certainly judges, if you are prosecuted, and the prosecution themselves will seek to characterise these cases as deliberate stealing of much needed public funds designed to keep companies afloat and employees in job. It is something that will be taken seriously and punished appropriately. So if we could move on to the next slide, please. So I'll summarise the ramifications fairly quickly. There's criminal sanctions that we've talked about. Personal liability for directors, both under the Finance Act, but also separate charges against directors, as well as the company concerned itself. And directors, whenever there's a criminal conviction for for fraudulent activity or fraud-related offences, the courts will consider directed disqualification proceedings, and that can be anything up to 15 years. There's the Proceeds of Crime Act. So the Proceeds of Crime Act sets out the legislative framework for the recovery of criminal assets, with confiscation being the most commonly used power. And you can expect confiscation to happen after a criminal conviction for furlough fraud. Money that is fraudulently claimed is a criminal asset, and as such, it could be confiscated from anyone who receives a conviction. And the purpose is very clear. The POCA, or Proceeds of Crime Act, is there to deprive people found guilty of criminal offences of the financial benefit they've obtained from their criminal conduct. This means that individuals and companies alike who are convicted and have financially benefited from furlough fraud could subsequently find themselves having to defend such sorts of proceedings. There's also alleged offences under the Proceeds of Crime Act alongside fraud in respect of money laundering, and that's something that needs to be considered. Clearly, reputational damage, whether through conviction, press, or publicised by the HMRC, is something that's going to have to be considered. And naturally, where there's been wrongful claims and penalties or criminal sanctions imposed, your insurance premiums, if you continue to trade, are going to increase. There's also the concern if you work in a regulated capacity, if you are regulated, whether it be through being an accountant, a surveyor, an architect, any of those regulated professions, and you're found of wrongdoing, you're going to have obligations to notify that to the regulator, and individuals may find themselves coming under scrutiny about their ongoing ability to act in their profession. And finally, companies can be exposed, or if they've been exposed or susceptible to fraud, there is a strict liability offence for failing to prevent tax evasion. It hasn't been widely used. It was introduced in 2017, and the only defence to that is to show that you did have in place reasonable preventative procedures to prevent the facilitation of tax or that taking place, and it was reasonable in those circumstances to expect those procedures in place. So that gives you a summary of, and it is a broad overview summary. You know, due to the time constraint, I appreciate we're almost at the end of that time. So if we go to the next slide, please. Inevitably, with any large grant or scheme or project, there's going to be elements of corruption or fraud, or even basic error through ignorance and misunderstanding. The same is to be expected in the present case with furlough and self-employed income support schemes. HMRC have said they will not actively seek out those who have made innocent mistakes in relation to the furlough scheme and who have sought to repay any monies which have been incorrectly claimed. However, they will not tolerate deliberate wrongdoing and will actively investigate those cases where fraud is suspected. It will no doubt wish to make an example of those who have sought to defraud the public purse at a time of national emergency. And so the message, as I put on your screen, is clear. The pursuit of businesses, directors and individuals who have abused the furlough scheme means others sadly will get caught up in the scrutiny. It's fundamental that all continue to keep and maintain full and complete records of all their claims under the scheme, the reasons for their claims, and identify any discrepancies. It's fair to say the coming storm of COVID fraud scrutiny, investigation and potential charges is fully on its way. Next screen, please. So before we take any questions, we will be sending a recording round to everyone that signed up to today's webinar tomorrow morning. We'll also include a link to a very short feedback survey and would really appreciate it if you could complete that so we can make sure our future webinars are helpful to you. Next screen, please. As I said at the start, this is one in a series of Wednesday webinars. Our next webinar is the Director's Duties and Twilight Zone, an update on the 22nd of September. And if you're interested in that and our future webinars, please visit the website or our Eventbrite page and sign up. So without further ado, I will now take any questions that anyone may have.
Hi Tej, we've had a few actually. So we will start with if a business notifies the HMRC of an overpayment following the 90-day grace period, will they still incur a penalty pursuant to the Finance Act 2020?
In short, yes, the HMRC may charge you a penalty if you fail to notify them or do not notify them within the time frame prescribed. You know, for example, if you ask someone else, such as an employee or an advisor, to do something on your behalf, you must do as much as you can to make sure they've done that, and that could be the notification process. The HMRC have said they won't charge a penalty for a failure to notify if the following provisions apply. Number one, you've got a reasonable excuse for that failure. Number two, that failure to notify wasn't deliberate, and you notified the HMRC without any unreasonable delay after that reasonable excuse had ended. Now, if you fail to notify, if the failure to notify them is deliberate, then any of the reasonable excuse provisions would simply fall away. But if you do have a reasonable excuse, it's important you do tell the HMRC. It's important they are aware of the position so they can assess the full picture before making their decision. And whilst you may still have a penalty imposed, you may not. But if you are imposed with a penalty, the HMRC have published guidance. You know, if it's non-deliberate and you have contacted them, albeit out of time, without them prompting you to do so, the penalty could be as low as 5%, 10%, up to 30%. At the other end of the spectrum, if they've had to prompt you, and it's plain that you deliberately failed to notify them, the fine going to be as high as 100%. Now, depending on how much you claim, that could be a significant sum involved. So the bottom line is yes. And I go back to, it's best to have that audit process now, check the position, and notify as promptly as possible. If you're outside of that time, the quicker you notify, the better the circumstances will be.
Okay, thank you. Another one here. If you are an employee and you know the employer has been incorrectly claiming CJRS, can the employee be prosecuted? I know there is a protection from unfair dismissal, etc., under whistleblowing legislation, but in practice, the prospect of not having work would focus the practical issue of having money over what is the right thing to do. So
the bottom line is it's clear the HMRC are not targeting employees. The HMRC actually have, and I'm not going to get into employment law, that's way beyond my arena, but the HMRC have an online portal for employees to anonymously whistleblow effect and report instances where they believe their employer has been incorrectly or inaccurately claiming furlough payments. And you know, the bottom line is the benefit that's being received from those inaccurate furlough payments are to the company. The employee is doing their work, they are being paid. If an employer is, in addition to that, claiming inaccurate furlough payments, the benefit is to the company, and that's going to be the target of HMRC in terms of clawing back any monies. Now, the only instance I could see where employees may get pulled into the fray is under the allegation of conspiracy to defraud. You know, if there's an employer and employee collectively coming up to an agreement to incorrectly claim furlough and they're both benefiting from it, that is one arena that perhaps an employee will be targeted. But I don't see how employees will be targeted by the HMRC.
Okay, thank you. Next, what if I instructed an agent to carry out the application process on behalf of the business?
So the HMRC will, the bottom line is the HMRC will seek to impose a tax charge of 100% and a penalty to the equivalent of 100% on the business itself who received the funds from the respective scheme, grant, having proper effects with regard to the circumstances. But one aspect of the process will take into consideration the behaviour of the business and the reliance on professional services. And that will be viewed as to whether any actions have been deliberate or not. But the guidance is fairly clear. If you've asked someone else, including an advisor, to do something on your behalf, you must do as much as you can to make sure that failure doesn't occur. Now, you know, I appreciate advisors may have made claims. They will be reliant on the information presented to them by an applicant. But ultimately, you know, if the HMRC come to a finding and impose a penalty and you disagree with that, then you've got a period of 30 days to provide them with any additional information, whether it be directly or, you know, by your accountant or such like. You can request an independent review, and ultimately there is an appeals process before an independent tribunal. You know, I appreciate that some may be concerned if they've engaged professionals, and I don't say this lightly, but professionals will equally have concern as to about any negligence claims coming off the back of companies facing penalties from the HMRC. So the bottom line is the claim will be made by the HMRC to the business itself. It's difficult to give a generic answer because each case will have its own merits. But if you believe that you've got a reason that it was not deliberate and there's a reason why an error or a mistake has happened, it's key that that information is relayed to the HMRC, whether in the form of advance information, representations, once you're notified of the outcome, and ultimately, if you're still not satisfied, you go through the appeals process.
Okay, thank you. Next we've got from Mike. HMRC has historically been driven by statistics. Do you think that it's likely that their focus on furlough fraud will be aimed at the low-hanging fruit, i.e. easy targets who are likely to settle, rather than more complex cases which will be defended?
It's a good question. I suppose I would agree. Firstly, I would agree with the view that HMRC are historically perceived to have been targeted by statistics. Do I think the same applies moving forward? It's going to be difficult to tell. Ultimately, the bigger the companies, the more money that's going to be involved. Now, I think the HMRC, because their claims are going to be significantly higher than perhaps a smaller company with 3 to 4 employees. But I think the important aspect is going to be they're going to want to make examples of people, and I think they are going to try and avoid criminal prosecutions. But if there's blatant discrepancies, blatant fraudulent activity, then they will go after the big companies. The big companies may well defend it. But as you know, my view is the importance of defending it for the smaller companies is equal, because it's not going to be just the big companies that have their details publicised for default. It's going to be the smaller companies as well. I think there will be more difficulties in assessing the bigger companies because there'll be more complexities, more layers, more reasoning. So I think it would be easier to view and analyse a smaller company in the short term. But these claims by the HMRC are going to last for the next 4 to 5 years. It's not going to be a quick resolve. And so I think in the short term, it will be perceived that smaller companies are being targeted. But I think that will level out over the course of the long term as the large companies are assessed in detail, and things surface in the next 3 to 5 years.
Okay, thank you, Tej. That's all the questions we've had.
Fantastic. Well, thank you everyone for today. And if you are faced with any of the issues that I've outlined today, or in fact any regulatory or criminal related issues, then please do not hesitate to get in touch with us. And thank you for your time.